What does it all mean? The lessons of market history are clear. Styles and fashions in investors' evaluations of securities can and often do play a critical role in the pricing of securities. The stock market at times conforms well to the castle in the air theory. For this reason, the game of investing can be extremely dangerous. Another lesson that cries out for attention is that investors should be very aware of purchasing today's hot news issue. Most initial public offerings underperform the stock market as a whole. And if you buy the new issue after it begins trading, usually at a high price, you are even more certain to lose. Investors would be well advised to treat new issues with a healthy dose of skepticism. Certainly, investors in the past have built many castles in the air with IPOs. Remember that the major sellers of the stock of the IPOs are the managers of the companies themselves. They try to time their sales to coincide with a peak in the prosperity of their companies or with the height of investor enthusiasm for some current fad. In such cases, they argue to get on the bandwagon even in high-growth industries produced a profitless prosperity for investors. So we read. I read this paragraph. So in Korea stock market, the Kospi figures hit 3,000 figures. So remarkable figures at the time because it means of COVID-19 pandemic, and so it's really interesting situation now. And also, in my case, I take part in some IPO, as you guys know, so BTS Entertainment and big hit company, and I got some profit at the time. And okay, let's see the next paragraph. The nervy 90s. The Japanese yen for land and stocks. One of the largest booms and busts of the late 20th century involved the Japanese real estate and stock markets from 1955 to 1990. The value of Japanese real estate increased more than 75 times by 1990. The total value of all Japanese property was estimated at nearly $20 trillion, equal to more than 20% of the entire world's worth and about double the total value of the world stock markets. That's remarkable things. And America is 25 times bigger than Japan in terms of the physical archaeology, and yet Japan's property in 1990 was appraised to be worth 5 times as much as all American property. Theoretically, the Japanese could have bought all the property in America by selling off metropolitan Tokyo, just selling the imperial palace and its grounds at their appraised value would have raised enough cash to buy all the California. The stock market countered by raising like a helium balloon on the windless day. Stock prices rised hundredfold from 1955 to 1990. At their peak in December 1989, Japanese stocks had a total market value of about $4 trillion, almost 1.5 times the value of all US equities and close to 45% of the world's equity market capitalization. Fund foundation investors are aghast at such figures. They read with dismay that Japanese stocks sold at more than 6 times earnings, almost 5 times book value, and more than 200 times in dividends. In contrast, US stocks sold at about 15 times earnings, and London equities sold at 20 times earnings. The high prices of Japanese stocks were even more dramatic on a company-by-company comparison. The value of NTT Corporation, Japan's telephone giant, which was privatized during the boom, exceeded the value of AT&T, IBM, Exxon, General Electric, and General Motors put together. Daiichi Kangyo Bank sold at 56 times earnings, whereas an equivalent US bank, Citicorp, sold at 5.6 times earnings. Nomura Securities, Japan's largest stockbroker, sold at a market value exceeding the total value of all US brokerage firms combined. Two myths propelled the real estate and stock markets. The first was that land prices could never go down in Japan, and the second was the stock prices could only go up. These myths were forged by large amounts of cash from the Japanese tradition of almost compulsive saving and by extremely low returns from regular saving accounts, which 1%. Playing the stock market became a national preoccupation. Almost overnight, Japanese male commuters switched from their usual pornographic comic books to lurid tales of vivid conquests of the stock market. It is said that in Britain there is a betting shop or tough accountant. On every corner in Japan there was a stockbroker on every corner. Supporters on the stock market had answers to the all logical objections that could be raised. Were price-earning ratios in the stratosphere? No, said the salespeople at Kabuto Chu, Japanese Wall Street. Japanese earnings are understated relative to US earnings because depreciation charges are overstated and earnings do not include the earnings of partially owned affiliated firms. Price earnings multiples adjusted for these effects would be much lower. Were yields well under first 1%, unconsiderably low? The answer was that this simply reflected the low interest rates at the time in Japan. Was it dangerous that stock prices were 5 times the value of assets? Not at all. The book values did not reflect the dramatic appreciation of the land owned by Japanese companies, and the high value of Japanese land was explained by both the density of Japanese population and the various regulations and tax law restricting the use of habitable land. In fact, none of the explanations for the soaring heights of the real estate and stock market could hold water. Even when earnings and dividends were adjusted, the multiple were still far higher than in other countries and extraordinarily inflated relative to Japanese own history. Moreover, Japanese profitability had been declining and the strong yen was bound to make it more difficult for Japan to export its products. Almost land was sourced in Japan. Its manufacturers, such as its automakers, were finding abundant land for new plants at attractive prices in foreign lands, and rental income have been rising more slowly than land values, indicating a falling rate of return on real estate unless prices continue to skyrocket. Finally, the low interest rates that had been underpinning the market had already begun to rise in 1989, much to distress of those speculators who had concluded that the fundamental laws of financial gravity were not applicable to Japan. Isaac Newton arrived there in 1990. They show me the Japanese stock market bubble, Japanese stock prices relative to book values 1990 to 2000. So it is from the Morgan Stanley researcher and author estimate the stock market figure the surge of the 1986, so maybe 2.5 times more than previous year, and keep going and plunges the figure in 1990. Yeah. Okay, keep going. Interestingly, it was the government itself that dropped the apple. The Bank of Japan Federal Reserve, so the ugly specter of a general inflation staring amidst the borrowing frenzy and the liquidity bomb underwriting the in land and stock prices. And so the central bank restricted the credit and engineered a raise in interest rates. The hope was that further raises in property prices would be chalked off and the stock market might be eased downward. Interest rates, which had already been going up during 1989, rose sharply in 1990. The stock market was not eased down, instead it collapsed. The fall was almost as extreme as the US stock market crash from the end of 1929 to mid-1932. The Japanese Nikkei stock market index reached a high of almost 40,000 on the last trading day of the 1990s. By mid-August 1992, the index had declined to the 14,309, a drop of about 63%. In contrast, the Dow Jones Industrial Average fell 99% from December 1929 to its low in the summer of 1932. Although the decline was over 80% from the September 1929 level, the chart on page 76 shows quite dramatically that the rise in the stock prices during the mid and the late 1890s represents a change in valuation relationships. The fall in stock prices from 1990 on simply reflected a return to the price-to-book value relationship that were typical in early 1980s. It is more difficult to date and measure the collapse in the real estate market because property rarely changes hands. Nevertheless, the air also rushed out of the real estate balloon during the early 1990s. Various measures of land prices and property value indicate a decline roughly as severe as that of the stock market. The bursting of the bubble destroyed the myth that Japan was different and that its asset prices would always rise. The financial laws of gravity know no geographic boundaries. The collapse of the bubble in Japan had profound effect on the financial system and on the Japanese economy. Unlike their counterparts in the United States, Japanese commercial banks, life insurance companies, and even non-financial corporations themselves hold large amounts of stocks and real estate. The bursting of the bubble weakened the entire financial system and was followed by a severe recession that lasted into the next century. We are gonna see some chapter 4, and chapter 4 is the biggest bubble of all: surfing on the internet. If you can keep your head when all about you are losing theirs, blah blah, yours in the earth and everything that in it. Rudyard Kipling. If We save for last what we undoubtedly the biggest bubble of the 20th century, if not all time. Indeed, comparing the internet bubble to the truly birth craze is unadaptedly unfair to the flowers. Most bubbles have been associated with some new technology, as in the electronics or biotech booms, or with some new business opportunity, as when the opening of profitable new trade opportunities swarmed the South Sea bubble. The Internet was associated with both. It represented a new technology, and it offers new business opportunities that promise to revolutionize the way we obtain information and purchase goods and services. The promise of the Internet swarmed the largest creation and largest destruction of wealth in all time. When the bubble popped, over $8 trillion of market value evaporated. It was as if a year's output of the economies of Germany, France, England, Italy, Spain, Holland, and Russia had completely disappeared.